Everybody says they want to buy stocks when they're on sale. But when those prices finally drop, suddenly everyone runs for the exit like a building's on fire. Today, I'm going to show you 5 really beaten down stocks that have fallen significantly this year and the exact price I'd be willing to pay for each one. So what if I told you the best investing opportunities don't come from hot tips, breaking news, or someone yelling buy on TV or YouTube? They come from one thing: mispricing. When a business with real cash flow, real strength, a real story suddenly trades at a price that just doesn't make sense, that isn't in line with the fundamentals there. In a few minutes, I'm going to share why we get excited when stocks fall and how that gets us excited as value investors, not speculators. But even more important, I'm going to give you the right tools and the right principles so that the next time you see a mispriced stock, you're going to recognize it instead of running away like most investors do as a stock's price falls. Today, when I show you the stocks we're going to analyze, you'll be able to use this lesson. You're going to start to recognize when price becomes disconnected from value and how that presents an opportunity. In this market, price is above value for a lot of companies, but sometimes it goes this way. You've got to be able to do that. That is principle-driven investing. That's how wealth is built in the long run. Now, guys, remember, these 5 stocks are down. It doesn't make them a buy. Just because a stock is down does not make it a buy. It makes it cheaper, but it doesn't make it cheap. Now, first stock, personal favorite of mine, not the stock, but the company. And I want you to hear that. Personal favorite of mine. I want everybody to see my current phone. I have a 2,327-day streak on Duolingo. 2,327-day streak on Duolingo. That is our first stock. They are a language learning app that lets people learn for free with the option to pay for extras. Kind of like Netflix, but for language lessons. The stock is down, guys, 48% year to date. 48%, because the company is spending more on AI and long-term growth, which has investors worried about lower cash flow and profit in the short run and slower user growth right now. I always tell people, start with Stock Analyzer. The reason being is, don't waste your time following a company that makes that the price is so disconnected from your price that you would even look at it. If you're out looking for a car and you say to a salesperson, I'm looking for a car, they say, well, here's our $1 million, $2 million Bugatti. Would you say, all right, let's talk about this? No, you'd say, well, I'm looking for a $40,000 car. You would immediately stop and say, no, I need $40,000 car. So, revenue growth over the next 10 years. I'm going to do a 10-year analysis. Let's do 10, 20, and 30%. Look at this profit margin and free cash flow margin, growing tremendously. I'm going to sit here and put in 30. Let's go 33, 43, and 53%. And remember, guys, it's a young company, so I'm speculating here. But this is important. Now, what's the appropriate PE and price to free cash flow 10 years from now? That's the question we need to ask. 10 years from now, what is that number? Well, guys, I always tell people 15 to 16 is the market average. You go higher for great companies, lower for bad companies. This company is pretty awesome. It leads the world in language. So I'm going to put in 16, 20, and 24. And guys, I'm throwing off the cuff here. I'm just trying to get some numbers out there to see if we're even in the realm of possibility. And finally, my 9% desired return, it's the market return to figure out what is this thing worth. But I'm not going to buy it based on a 9% return. I need a margin of safety, which means a much higher return than this. But the stock's currently at 170. Hit the analyze button. Damn! Yes, guys, I'm going to do more research. I have a low price of 175, high price of 1700, middle price of 570. Now you might be wondering, Jesus, Paul, look how far apart these are. These are 10x. Well, yeah. That's what happens on newer companies that have a lot of wide different revenue growth assumptions. That is what's impressive. So for me, I'm adding this immediately to my list of companies I need to do more research on. Now, guys, to validate these, I go to analyst estimates. My biggest concern is revenue growth. Look at analyst estimates, 37, 26, 22, 13. So it doesn't seem like 10, 20, and 30 are that far off. Maybe it's not that big of a deal in terms of my assumptions being too high. Could have been a little bit lower. Sure, maybe 10, 15, and 20. But guys, guess what? Even if I change this to 10, 15, and 20, I still have 175 in the low, 808 in the high, 388 in the middle. Still over a 20% potential return if this works itself out. If the numbers feel overwhelming, you're not alone. We're going to do 4 more companies and we're going to do a lot more detail in the numbers. We're here to simplify all of this in our videos. So it's really important. Some of the metrics we go over here, I want you to have a cheat sheet. That's why I created an absolutely free cheat sheet. That way you can look at these numbers, understand them, keep them at your desk, keep them on your phone, so that when you watch our videos and go, what does that metric mean? It's right there ready for you. So click the link below, download it. It's our key metrics from our main page. So if something for Duolingo, it gives you all these key metrics absolutely free at your fingertips. This is why I teach on YouTube, guys. Nobody's talking about this stuff. All they're talking about is, oh, look at this stock, it's going up. I think there's a lot of momentum. It's a great story. That's not investing. That's speculating. Stock number 2, Hims. This stock has been all over the place. Hims is an online platform that helps people get treatment for things like hair loss, mental health, sexual wellness by connecting them with doctors and shipping products right to their door. The stock has dropped 30% in the last 6 months because of rising competition, especially in the weight loss space, along with concerns about how long its growth can last, trust in the brand as it expands, and recent insider stock sales that made some investors a little nervous. On the 10-year analysis for Hims, my first assumptions were revenue growth, 10, 20, and 30%. So before we look at that, let's go to our main metrics page. Guys, their 3-year growth rate was 70%. Their 5-year growth rate is 76%. And I'm looking at 10-year growth rate. Now, this is a young company. We don't know where it's going to end up being. But I think my 10, 20, 30% is very reasonable for the next 10 years. Let's see what analysts think. For the next 4 years, 20%, 18%, 5, and 11. So actually, maybe my middle assumptions are too high. So I'm going to go back here. And because I look at analysts going, they tend to be more optimistic, I feel, than most. So I'm actually going to do 8, 12.5, and 20%. I'm going to go a little bit higher here. So I've adjusted my revenue growth numbers. Next, profit margin, 15, 25, and 35. As you guys can tell, the profit margin and free cash flow have not been there lately. But I'm going back to this main page. Gross profit is 75%. Their 5-year profit margin is 0.6%. Last year was 6%. So I'm looking at this saying, can they get higher? High gross profit margin here. That means every extra dollar they sell, 75 cents of it, goes to the bottom line before overhead and taxes. That's really important. So I'm making a little bit of a leap here by saying 15, 25, and 35%. But I'm fine keeping it there right now. Now, what's the PE 10 years from now? I put 16, 19, and 22, and I guess, again, my 9% desired return. The stock's currently at 37. I hit the analyze button. All right. 31 on the low side, 225 on the high side, $81 in the middle. Big potential return. But again, that was based on 25% margin. If we change this to 10, 17.5, and 25 there, let's see how much it changes it. We still have a pretty decent go of it. So as long as they don't issue a lot of shares to dilute people, this looks like something interesting. We are 2 for 2 right now on looking at companies that deserve more attention, in my opinion. Again, it doesn't mean you buy them. It means because they're 2 young companies that just went public recently. You've got to be aware of that. Stock number 3, Novo Nordisk. NVO is a global pharmaceutical company best known for its diabetes and weight loss drugs like Ozempic and Wegovy. The stock has fallen 56% in the last year because of growing competition from Eli Lilly, weaker future sales forecasts, pricing pressure from the US government, and slower than expected demand for its obesity treatments. Guys, this company is great, but there is a lot of growing competition for these weight loss drugs. So let's go to our stock analyzer tool. Let me put in NVO. See what I did last. 10-year analysis, revenue growth 4, 8, and 12%. Well, guys, on the main page, 3-year revenue growth rate, 23.59, 5-year, 19.93, 10-year, 11.8. So I'm going low, it seems. Let's see what analysts think. Now, analysts are a little more conservative than this. They're in the high single digits, basically double 10% growth per year in terms of revenue. So let's see this. Now, guys, free cash flow, profit margin. The free cash flow over the last 10 years has actually gone down. Is this something that's going on? Are they spending more money? Let's go find out in there, because cash flow is driven by capital expenditures. The higher your capital expenditures, the worse your cash flow. And look, Capital expenditures are up a lot in the last 5 and 10 years. They used to be $1 to $2 billion a year, every so often a fluke year. It is $9.7 billion. Why? We need to understand that. So I'm not as worried about this as other people might be. I'm going to focus on the profit margin for now. Again, PE 16, 19, and 22. And then a desired return of 9%. The stock's currently at 45. I hit the analyze button. I have made every possible investing mistake you can imagine. I bought too high. I sold too early. I listened to the wrong people. And that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. Man, another one. Low price of 50 to 56, a high price of 140, middle price of 85. Guys, I want to make note before we go further. If you look at our past videos, people are always saying, oh, you never find stocks that are interesting or all green. We've just found 3. I went in this blind. I had no idea what stocks they picked, guys. I'm going this completely blind. We have 3 stocks that, in my opinion, deserve more attention. Again, doesn't mean they're a good buy. Stock number 4. Guys, we've talked about this one. We've made videos on this one. This one is quite interesting. When it was at 160, it is now at 170. So not far off. It is Lululemon. Lululemon is a premium athletic apparel brand that sells workout clothes and gear through its own stores and website. The stock is down 54% year to date because of slowing sales growth in North America. Not sales being down, slowing growth. Rising costs due to tariffs, tougher competition, and a weaker outlook that made investors worry about shrinking profits and future growth. Now, guys, let's go to our stock analyzer tool. And remember, I've talked about this in Lululemon many times. Fashion is cyclical. Is Lulu another Nike? I don't know. I don't think so, but does it have the potential? Possibly. You've got to remember, though, that all these brands come in and out. The question is who has staying power. So on our 10-year analysis, revenue growth, I did 4, 7, and 10%. You can see right here, declining revenue growth over the last 10 years, still growing, but not as fast. If we go to analyst estimates, look at this, guys. They're actually more pessimistic than me. They've got 6, 6.5, 5.5, 11, and 7%. So I might be overly positive on them. But remember, just because something might not have as good a story doesn't mean it's not worth it. Look at this. In the last year, Lululemon created $1.17 billion in free cash flow. If I sold you the company for $1, would you buy it? Of course you would. You make your money back in 1 millisecond. If I said to you $1 trillion, would you buy it? Hopefully you would not. That's the point we're trying to get to. So back to Stock Analyzer. Now, profit margin and free cash flow. There are discrepancies here. Have to understand that. But I'm going to focus here on some sort of combination. I did 14, 15, and 16% on profit margin. Keep in mind, they did 16% only over 1 year, which is our high range. And I did 13, 14, and 15% on free cash flow, even though their free cash flow is consistently around 11% or so, maybe 12. So I'm being a little optimistic on the free cash flow, thinking it'll catch up. PE and price of free cash flow, 16, 19, and 22, and a 9% return. I hit the analyze button, and guys, low price of 203 to 220, high price of 460 to 488, middle price of 300 to 320. We're 4 for 4 now, guys. And I want to repeat before we go to our 5th and final stock. These are all great numbers. The question is, how accurate are these numbers? Once you see this and see all this green, when you do more research, you're going to pull back the layers. My biggest concern on Lulu is, will it be a premium brand forever? Will it be an amazing brand for women and men forever? That is the question. If I knew for sure that somebody came down and said, Paul, 30 years from now, Lulu will still be around and their revenue growth would have been 7 or 8% a year for the rest of the time, I'm jumping on this all day. I'm going to make a killing in the next 30 years. But we don't know that because the future is unknown. and we're humans and we make mistakes. That's the key to investing. Stock number 5, Fiserv. Guys, this company, $33 billion company, they're a financial technology business that helps banks and businesses process payments, run digital banking, and manage point-of-sale systems like Clover. The stock has dropped hard, 70% year-to-date after missing earnings, cutting its forecast, facing slower growth in key areas like merchant services, and shaking up leadership. Could you have anything happen to a company more than that? All of these are serving big concerns about how well the company is being run. Guys, this stock was at $238 back in March of this year. A mere 8 months ago, $238. Look at that. It was up for the year at that point, and it's just collapsed since. Look at all these big gaps down. Big gap, big gap, big gap. Let me get rid of this thing. Big gap, all drops. You know how we say gaps fill? Well, that's not over here. This company has absolutely been hit hard. Ironically, we have community members who think it's a buy. So let's go to our stock analyzer. Let me see if I've ever done this company. I don't think I have. So we're going to do this. We're popping our cherry right here, guys. So first off, the return on capital sucks, but it's hopefully getting better. The last 10 years, 6.6. The last 5 years, 4.3. Last year, 7%. Revenue growth has absolutely plummeted. Oh boy. Let's see what analysts think about this revenue growth. No data available. All right. So no data is available. So I got to sit there and figure out, make some assumptions here. I'm going to do 6, 9, and 12%. Profit margin. As you can tell, 10-year average, 13.5, 14. Free cash flow is way higher. We're going to focus on free cash flow. So I'm going to do just 15 across the board because I don't really care about this. And for free cash flow, I'm going to do 17, 19.5. No, 17. Let's go 17, 20, and 23. PE. 14, 17, and 20. Because remember, guys, low returns on capital has been around for a while. I don't really know. Like, I'm looking at their gross margin. That's 61%. That's a lot. So I'm looking at going, this company should be able to grow their revenue pretty solid, but it might be in a more congested area. And I'm going to do a 9% desired return. Hit the analyze button. So here's what I got. Another big one. 108 to 122, 215 to 328, 150 to 200. Guys, I don't remember the last time we did 5 stocks that were all green. This is probably something you have to look at. Make sure you understand which companies you're buying and why you're buying them. And guys, earlier this year, I decided to challenge the famous Magnificent 7 by picking my own 7 stocks to start the year. Click the video on your screen to see which ones I picked and how they stacked up against the market's Mag 7. And wait until you see how they're performing. You will not expect this. Thank you for your time.